Throughout history, gold has been seen as real money, the ultimate store of value. Empires rise, currencies collapse, economies evolve, but gold keeps its shine. And there's one relationship that never fails to fascinate investors. When the US dollar weakens, gold usually rises. It's not coincidence. It's a reflection of how the world views trust, value, and fear. Let's break down why this happens and what it really means for your money. Gold is traded in US dollars all over the world. That means its price is directly tied to the dollar's strength. Imagine you're in Europe. If the dollar weakens against the euro, gold suddenly becomes cheaper for you to buy. So you, and millions of other investors, rush in. That wave of demand pushes gold prices higher in dollar terms. In simple words, when the dollar falls, gold often rises because it takes more dollars to buy the same ounce of metal. It's like a seesaw. When trust in paper money dips, trust in gold lifts. The US dollar isn't just a currency, it's the backbone of global trade. Oil, commodities, and even international debt are priced in dollars. So when the world starts to question America's economic health, maybe because of rising national debt, political instability, or inflation, investors start looking for a safer home for their wealth. That's where gold comes in. It's not controlled by any government. It can't be printed, frozen, or inflated away. Owning gold is like saying, I trust in scarcity, not promises. That's why when people lose faith in fiat currencies, gold becomes the alternative language of trust. Here's where monetary policy comes in. When inflation rises, your dollar buys less. Groceries, gas, rent, everything costs more. But gold tends to hold its value because its supply barely grows, only about 1 to 2% a year. Now, when the Federal Reserve lowers interest rates to stimulate the economy, holding dollars or bonds becomes less rewarding because yields drop. Investors then look for assets that protect purchasing power. And again, gold becomes attractive. That's why you often see gold spike after the Fed announces rate cuts or stimulus programs. Money printing might help the economy short-term, but it quietly eats away at the dollar's value. And gold, being timeless, simply reflects that reality. There's another layer, central banks themselves. In recent years, countries like China, Russia, and India have been buying record amounts of gold. Why? Because they want to reduce dependence on the US dollar system. It's called de-dollarization, and it's reshaping global finance quietly but powerfully. When central banks diversify their reserves from dollars into gold, it adds even more long-term demand, reinforcing the cycle, less trust in paper, more love for metal. Gold and the dollar are two sides of the same coin, one backed by faith, the other by history. When confidence in the system fades, gold shines. When the dollar wobbles, gold steadies the ship. It's not about predicting prices. It's about understanding why people turn to gold when money itself feels uncertain. So next time you see gold surging, don't just think it's about jewelry or speculation. It's a message, a quiet whisper from the market saying, something in the system doesn't feel stable. If you found this breakdown helpful, subscribe to The Real Wealth Vault, where we turn financial complexity into clarity. Because true wealth starts with understanding the system that runs the world.